Welcome to the Insightful Investor Podcast, a weekly series that seeks to share industry, investment, and market insights. Learn more about our show at insightfulinvestor.org. Welcome to part 2 of the top 10 insights from 2025. In case you missed it, part 1 was released last week and covered insights ranked 10 through 6. Today, I'm sharing the top 5 insights from 2025. A quick note before we begin. This episode is much longer than usual. We had so many great insights this year that it was tough to narrow them down. Even after making a lot of cuts, there was still quite a bit worth sharing. I hope you find the depth and variety as valuable as I did. Let's get started. Number 5, inflation's return after decades of calm. For decades, inflation was an afterthought, barely on the radar for most investors. But after years of stability, uncertainty around inflation has returned. Why is it so hard to predict? How does it affect portfolios? And what do investors often get wrong about this risk? Greg Shernow, Managing Director and Portfolio Manager at PIMCO, joined the show in early June. In this clip, he breaks down the supply and demand dynamics that drive inflation and why investors often underestimate the risk.
Inflation is going to generate when there's an imbalance between supply and demand. When demand is exceeding supply, higher prices you would expect to either disincentivize demand or incentivize new supply. So when you have inflationary episodes, the genesis of the backdrop to those are really just that imbalance. Now, some of them are slower boil. If you look at the early 2000s, for example, when commodity prices in particular, and I'll focus on commodity because it's the most volatile component of inflation, but most of what I can say could be applied more broadly to any economic drivers of inflation, whether it be real estate or whatnot. When you look in 2000s, it was China growth that steadily exceeded expectations that ended up whittling away at any of the surplus supply capacity that existed in the market. And then you needed to get much higher prices to disincentivize demand and increase supply. Or you could have examples like in the 70s or post-COVID, let's say, or certainly the Russian invasion, where you have a supply shock, where there is a contraction of supply. That tends to be a very challenging environment, but then you end up with higher prices as well. But from an investor standpoint, there's something we discovered, or rather we were discussing at a Secular forum a few years ago. And Secular is our annual 3-day conference where we get out of the mindset of thinking about what's the next 6 or 12 months, and we try to think of what's like the next 3 to 5 years and beyond. And we had a speaker who talked about how important your year of birth was at determining your sensitivity to different inputs or your views on certain markets. So if you were born mid-70s, you don't know inflation. You don't remember inflation. It doesn't inform your understanding of the world. And the vast majority of people on Wall Street sitting on any trade floor right now will fall into that bucket. But if you ask someone before, they have a much different expectation and understanding of what inflation can mean.
It's very different living through it than it is reading about it.
Oh, for sure. I didn't have to go through gasoline lines. I was born in the late 70s, so I got to avoid that experience. So why that's important is because if you're going to be thinking about where your biases are in your investment process and where your biases and your expectations of what cost of living could be, you have to really vet it against your starting points. And it's amazing how predictive that year of birth is in something like inflation. And it also then informs a lot of what portfolio construction is today, because a lot of it was generated after the mid-'80s where stocks and bonds were uncorrelated or diversifying. And then a lot of that was due to the fact that we just didn't have inflation.
I then asked Greg whether he and PIMCO believe we may be approaching an important inflection point for inflation.
Our general view is that we have moved out of a period where the forces of globalization, the peace dividend, central banks having increasing credibility is still there, but the inflation targeting that it came out provided a period of relatively low and relatively stable inflation. But a lot of those forces are going in reverse now. Certainly, deglobalization is making it so that we're not looking to invest in the lowest cost location, but we're willing to accept the fact, whether we for security reasons. I'm not saying any of it is purely a bad idea by itself, but there are implications of that. Some of the net zero goals or the energy transition in the short term, as in the next 3 to 5 years and maybe even longer, tends to be relatively inflationary because of the energy and commodity intensity of creating even something like a windmill, the amount of cement that goes into it, plus the amount of commodities that go into it. In the US, we have some shorter term unique implications, which is tariffs, which has a potential to actually have higher inflation. Also, the volatility of those tariffs are increasing the volatility of the estimates inflation market. I think last week we had a 25 or 30 basis point move in the 1-year break even. These are pretty meaningful challenges to what would normally be a rather stable outlook for inflation in the grand scheme of things. Because I do think the longer term also of the fiscal stimulus that is likely to come down the pike is also another area. We think inflation is going to be higher and more volatile in the secular horizon than it has been. But what ultimately will be the keys, and this is I mentioned before, like the difference between the demand side driven inflation and the supply side is pretty meaningful in terms of how the market corrects. Because when you get the supply side hiking central bank rates, which is helpful to slow the demand side to allow supply to come up, is not nearly as effective than if it's a demand side. There's real challenges when you have a supply side, inflation shock. You need to be able to make CapEx, and sometimes the CapEx, certainly in the commodity side, is a 3 and 5 year process. There are real challenges embedded in how you actually address it when you get the inflation. And certainly if we are making the markets less efficient, if we're bifurcating markets, and we haven't even talked in that, the geopolitics of it, because if you look over the last 5 or 10 years, the amount of, I don't want to describe them regional, but block-related trading, where Russia trades with China and India and Venezuela kind of ends up trading with those, but not with us anymore, or not with Europe, creates real rigidities also in the system that have an implicit cost to it.
Jason Thomas, head of global research at Carlyle, shared his perspective in early September. I asked him whether he thought we were entering a new inflation regime that could catch investors off guard. Here's what he said.
I think that that's almost an unmistakable conclusion to draw from this experience. It's back to school season. And I think it's interesting to note that there are about 3 million children who are getting their first taste of formal school in their pre-K4 education, and not a single month in any of these children's lives has the Fed hit its 2% annual inflation target. That's pretty remarkable when you think about it. And so even when people talk about inflation not being a problem or inflation's come down meaningfully, yes, it did, but again, still not to the level that the Fed, through a formal statement in 2012, the level that they formally committed that they will hit. And of course, we've seen recent data that's suggesting that inflation's a bit higher than people expected, but let's just go through those statistics. So first, you had core CPI inflation that came in through July at a 3.1% annual rate. Well, that's actually right on top of the 18-month average. So for the last 18 months, core CPI inflation has been 3.2%. If you look at the core PCE, which the Fed, of course, targets its preferred measure, that was 2.8% through June, also on top of its 18-month moving average. And then you could say the same thing about the 3.3% annual increase in core PPI inflation. So it's interesting if you look at the news and the market reaction to some of the recent inflation prints, it's been surprised that they've been a bit higher than expected. But in fact, they're exactly on top of where these numbers have come in for the past, again, 18 months, really since the end of 2023. So this has proven to be a much more intractable problem than people supposed. I think that this presumption that everything would sort of return to 2019 once we got that initial spike of inflation, which again, people attributed to a supply chain crisis, once that was over, everything would revert back to as it was prior to the pandemic. That just hasn't proven true.
I also asked Jason whether large fiscal deficits and elevated government debt suggest that policymakers might tolerate higher inflation as a trade-off for managing debt. Here is his response.
Well, this is an issue that I think we're going to confront. It's the issue of fiscal dominance. The reason that you have an independent central bank is because the Treasury or the finance ministry in other countries, in advanced economies, is able to borrow, issue debt in a currency that another arm of the government, the central bank, can print. From an investor perspective, this seems like kind of a dangerous situation. This would be like Microsoft issuing bonds instead of being payable in US dollars. Those bonds, both the coupon and principal payment, would be payable in Microsoft stock. Well, you never worry about a default event. The corporate treasurer can always issue more shares. What you'd worry about is what those shares are worth. And that's the situation that, again, advanced economies find themselves in, and why central bank credibility is so important. Because there's always this tension, or at least this risk, that these obligations are just going to be inflated away, that the one arm of the government, the central bank, is just going to print in whatever quantities are necessary to ensure that the other arm of the government, the Treasury Department, can fund itself. The idea of accepting higher inflation, it sounds very appealing. We just saw in 2021, when you think about how low yields were, well, there was very large capital losses as a result of that. When inflation went up, when interest rates went up, when bond yields rose, the market value of those bonds fell by some to 15 to 30%, depending on their duration. So investors, essentially, their wealth, you could say, was expropriated. It was effectively transferred to the government. And it's interesting because it feels as though bond market investors feel like that was a one-time event. So yeah, I bought this 10-year treasury bond yielding 1.5% for 100. Now it's worth 73 or 76. And well, that's too bad, but I know that'll never happen again. I wonder why, based on market yields today, why everyone's so confident this was in fact a one-time event.
Finally, Liz Ann Saunders, Chief Investment Strategist at Charles Schwab, joined us in early June to discuss why inflation can be so challenging for both investors and policymakers. I asked Liz Ann whether she expects inflation volatility to increase.
Yes. And I'm glad you asked the question that way, Alex, because if you had said, do you expect high and sustainable inflation on a forward-looking basis, my answer would have been no, but inflation volatility. So the period from the mid-1990s up until the early part of the pandemic, often referred to as the Great Moderation era, to your point, was characterized by limited inflation volatility, as a result, less monetary policy volatility, less overall economic volatility. We also had the massive wave in that era of globalization that really kicked into high gear in 2001 when China joined the World Trade Organization. We also had the energy boom in the United States, courtesy of fracking and shale, moving the United States to be energy independent. All of those forces conspired to provide that backdrop of a fairly benign inflation environment, somewhat benign monetary policy environment, leaving aside, obviously, the global financial crisis. And I think most of those ships, quite frankly, have sailed. And I think the environment we're arguably already in, if not in the process of transitioning into, may look a bit more like the period from the mid-60s to the mid-90s, where you had more inflation volatility. Again, that's not the same thing as saying high inflation for an extended period of time, but we certainly saw in the 1970s a tremendous amount of inflation volatility. I don't think that's what we're facing, because that was in large part due to monetary policy mistakes of hanging the victory banner, easing policy, only to see inflation let out of the bag again, then having to scramble and tighten policy. That happened 3 times in the 70s, ultimately leading to Paul Volcker having to come in and pull a Paul Volcker, ramp up interest rates, bring on back-to-back recessions in order to really finally break the back of inflation. But I think with this deglobalization or regionalization or just in case versus just in time, whatever terminology you want to use, not to mention geopolitics and demographics, I think means we're probably in a more volatile inflation backdrop, which again leads to potentially more volatility in monetary policy, maybe even fiscal policy, probably shorter economic cycles. The good news about the period from the mid-60s to the mid-90s is that the up parts of the cycle from an economic growth perspective were actually stronger than during the Great Moderation. So it isn't all doom and gloom with that comparison.
Inflation's return after decades of calm seems to be reshaping the investment landscape. As Greg, Jason, and Lizanne highlighted, the challenge isn't just the level of inflation, it's the uncertainty and volatility that come with it. For investors, that may mean rethinking assumptions, stress testing portfolios, and preparing for a wider range of outcomes. Number 4, what separates great leaders? What truly sets great leaders apart? It's not just technical skill or experience, it's the mindsets and the behaviors that inspire teams, drive resilience, and create lasting impact. This was one of the hardest sections to narrow down because we had so many powerful insights. I've distilled it to 9 guests who offered exceptional perspectives. Let's jump in. John Gray, president of Blackstone and one of the most respected leaders in global finance, offers a rare look into what truly defines exceptional leadership. In this clip, you'll hear his perspective on the qualities that separate the best from the rest.
I think a great leader just has a clear vision of where they want to go. Now, they may change that, but when you're leading an organization, it's just so much better when you know we're going to take that hill. That sort of clarity of vision, I think that's top of the list. And then I think somebody who has this relentless desire to win, to be successful. So we're going to take that hill faster than other people are. We're going to do it more efficiently, different costs, whatever. That to me is really important. That sort of just drive, that will to win. Somebody who can rally other people, to me, when you see that, people want to play their hearts out for somebody because nobody can do these things alone. You're working with incredible teams. When I think about the gift of my job, the human beings I get to work with, it's incredible. So if you can have this clear vision, you're willing to put everything into it to go get it, and you want to be successful, and you can get others to come with you, that to me is a very powerful combination. And you just can't be, I think when I see the people who are the greatest in sports or music, politics, they're just not satisfied. There's a level around these people where you meet them and you get this raw drive and hunger. And yeah, they've won 5 championships, but they want to desperately win a 6th championship. And that to me is the commonality. And somehow they're able to rally other people to what they're doing. And when you find that set of skills, to me, that's really special.
Next, John shares an insight that's often overlooked: the power of example.
I think people sometimes, and this is certainly something I learned, don't realize that when you're in a leadership role, how much everybody's looking at everything you do. I'll never forget, I was sitting in one of the meetings with my partner, Kathleen McCarthy, once, and she said to me, "What do you notice about all the young people at the table?" I'm like, "I don't know, whatever." She said, "The guys are all wearing blue suits and blue ties." And I said, I guess I wear that. And she's like, "Yeah, Dodo, the power when you're in a leadership position, I always thought you could only touch the people directly around you. The reality is there is this multiplier effect. So if you make it a goal that you're going to respond to every email before you go to sleep, even if you can't read everything, like, hey, thanks for that." And to me, it shows a sign of respect to the people who sent it to you. It shows you that you're in an organization who cares about timeliness, responsiveness. If you're doing that and you're pretty busy in your job, then the people beneath you will think that's important, and so on and so on. I think the example you set as a leader is more than folks recognize. And you don't need to be the CEO. You can just be the leader of your small team or whatever else. People are going to look at you, how you do things. And so I think that power to amplify what you do is the thing that I didn't fully appreciate. It's something I've realized more and more over time.
John also shared the mindset behind his personal motto: stay calm, stay positive, never give up, in this clip.
The genesis of this goes back to when I was raising my kids. My wife and I have 4 daughters, now all in their 20s. I came up with this phrase because sometimes people would get a little worked up, and it became what we called the motto in my family. And I basically kept it to myself, I would say, and my family. And certainly, if you go to the financial crisis, it was important to me, this basic idea that don't get too worked up. You've got to have a clear head. The situation looks tough, but there's always a way to get out. If you stay positive, it doesn't mean you think trees grow to the sky, but you just have this core belief that there's a way to get out. There's some light, there's a pony in there somewhere, there's something. And then just this idea of never giving up, because you see it so often in people's lives, in sporting events. You just keep going at it, and something will eventually break your way. There'll be a cyclical change and so forth. And I would say maintaining equanimity and positivity, certainly during the financial crisis, was incredibly important. I sort of crossed the Rubicon of spreading this gospel a little bit, I'd say, during COVID, where everybody was sent home. We started doing these Zoom calls with everybody. And I said, it's funny. This is what I say to my kids, but I need something, because everybody was rightfully, they were facing health challenges and education challenges for their kids, and they were worried about their parents. It was a very tough time. And so, yes, now every Monday when I sit here and do Blackstone TV, I sign off with stay calm, stay positive, never give up. And it's become a little bit of a thing here at the firm. And I don't know, it's sort of core to who I am. And it speaks to the way I think about things. And what's funny is, in the investment business, things always go wrong. There are natural disasters. There are things that happens in markets. You can never anticipate. So I think it is so important to maintain calmness and positivity and keep going. I don't know. For me, it's been super helpful in my career. And like everybody, look, when it's hard, when you're in the bottom of the financial crisis and you've written things down 70, 80%, the last few years when rates went up and you face different challenges, you can get discouraged. But I remind myself, hey, there's a way out. And my experience has been, if you're really smart, you're relentless, you just don't give up, something good will ultimately happen.
Katie Koch, CEO and president of TCW, emphasizes that great leadership starts with listening, and listening well. In this clip, she explains why active listening is essential for building trust and making better decisions.
Something my parents used to say to me when we were growing up is that if you're talking, you're not learning, which is true because you're listening to yourself speak. I always try and think about that and have the right balance of that when I'm meeting people. And one of the most powerful things that you can do as a leader is to ask good questions and give people the dignity of being heard in their responses and really be present in whatever they say to you. I get so much great information out of spending time with our employees and hopefully asking good questions and really hearing them on what they think is working, on what they think is not working, on what they think is happening in the markets. And I really use those conversations as an opportunity to learn. So I do think listening is an incredibly valuable skill. Not everybody appreciates that because sometimes people feel like the leader needs to be the one doing the talking. But you are right. Like great leaders learn to listen. And by the way, that's a skill I continue to work on. It's something I've gotten better at over time, but it's a place where I really try and hold myself accountable, that I'm actively and intently listening to our clients, to our employees, to people on the board. And it's something you have to really cultivate and continue to get better at throughout your life. I'm certainly better now than I was 10 years ago, but it's something I really want to continue to focus on and improve on.
Next, I asked Katie about an essential aspect of listening, seeking out different perspectives. She explains how incorporating diverse viewpoints helps leaders build a more complete picture of reality, rather than relying on a narrow personal view.
Society would be a lot better in general if we listened to each other and took in dissenting opinions, which as a country, we're not excelling at right now. But certainly in leading and running a company, it's a really good point. You have to be able to listen. It's easy to listen to people who agree with you. That's a beautiful place to be. It's very comfortable. You feel smart. You feel good because you're like, okay, I'm making the right choices. We're headed in the right direction. It's actually very difficult to sit with dissenting opinions, because it puts tax on the mind. It makes you think that you might not be making all the right decisions. So it creates more work because you're having to rethink some of the things that you might have done or conclusions that you came to. It's harder work. it's hard work to listen to people who don't agree with you and have dissenting opinions. And so that's a massive competitive advantage as a leader if you're able to actively listen to people and to sit with and really actually welcome in dissenting opinions. Have the humility to know that you're not right all the time and encourage people to disagree with you and do the hard work that it takes to not just listen to the dissenting opinion, but work through it and potentially come up with a different worldview or a different conclusion. This is very difficult work to do, but I think if you can do it well, it is an advantage. And I've been told that good leaders are surrounded by people willing to give dissenting opinions. And I'm at times drowning in dissenting opinions here. So I guess I'm doing a good job. But truly, I feel good, actually. I've said this before to people, but I feel more comfortable over time through a lot of work. I've been able to start to feel more comfortable with dissenting views because I know I'm not right all the time. So if I'm surrounded by a group of people who are reinforcing my worldview of either the company or the markets or whatever else, maybe that's actually when I start to get uncomfortable. Listening to dissenting opinions and working through them is hard work. Consensus can be very dangerous. So I feel more comfortable actually being surrounded by people who are willing to disagree. And obviously, when you're going to disagree with someone, you have to kind of be able to do it in the right professional way. If you can build a culture that embraces that, I think you're onto something very special.
Yi Shin Hunk, CEO of State Street Investment Management, which is one of the largest asset managers in the world. She explains why the most important decisions often become simple once the North Star is clear, even though complexity may lie just one level down.
I think the North Star is incredibly important, right? So that really speaks to this shared set of goals and objectives. What are we really trying to accomplish? What I think is really important is not only establishing that at the top of the organization, but what does that translate into specific goals and specific initiatives? And how do we measure whether we're making progress towards those? And having everyone in the organization feel like they have a set of goals and objectives and responsibilities that tie to what the firm is trying to accomplish. So if that effort results in a really clear North Star, but then that North Star felt everywhere throughout the organization, then I think you really are able to just power through a lot of complexity at whatever level in the organization. It does require, I think, in our organizations as they get larger, that people aren't just focused on their own specific goals, because oftentimes the big things that you're trying to accomplish require reaching out to lots of people in other parts of the organization or even outside the organization. So thinking about not only what you're trying to accomplish, but who are you working with to do that? And can you do that in a way that brings a lot of people together on that journey?
Alan Waxman, co-founder of Sixth Street, reflects on lessons learned during his decade at Goldman Sachs, where he became one of the firm's youngest partners at age 31, and how those lessons continue to shape his approach to investing and leadership. In this clip, Alan explains why culture is essential to building a successful investment organization, especially for teams operating across multiple asset classes.
What I learned at Goldman is because we were investing across so many different asset classes, the importance of culture. I ended up being the chief investment officer and running the group. Just to give you a sense, it's about a $25 billion of Goldman's balance sheet. So it's a big business. It's the largest principal investing business. We're a largest investing opportunistic investor at the time, probably in the world at the time. Now it's changed because all these big public guys, but back then, and really just the whole investment philosophy of constantly this whole idea that thematically, every theme has a shelf life. And something that's really good has a shelf life of 12 months to 36 months, and ultimately capital flows to it. And it gets a little bit less good, a little bit less good. Then it gets not good, and then it gets really not good. And then it basically sort of reverses itself and at some time gets good again. So we were constantly migrating to where the best risk reward is across themes and across asset classes. And then comparing this asset class to this asset class, this investment, effectively what we would call like unitizing risk units and return units. And that style of investing was dependent on culture, because if you had a bunch of teams and sector teams that weren't talking to each other, you really wouldn't be able to systematically compare relative risk reward between all these different asset classes. So that was the big aha, the sort of the connection between multi-strategy capital investing, which is what we were doing, and culture. So that was kind of on the investing side.
Blake Johnson is a serial entrepreneur, investor, and philanthropist, known for founding and scaling multiple companies without raising outside capital. He has successfully built and sold businesses with combined valuations exceeding $1 billion. First, I asked Blake how much of being a strong leader comes down to IQ versus EQ. Here's what he said.
Today, I think it is 80% EQ and 20% IQ. I've always kind of often observed that the first 22 years of a person's life, the schooling system really rewards you for IQ. How well you can read a page, regurgitate a concept or an equation or a passage on a piece of paper, and then quickly forget about that. The rules of the game drastically change once you get out of school. The world shifts. Business and leadership and really building things of value much more heavily depend on EQ at the later stages of the game. It's been an interesting thing for me to observe over the years, but having that EQ embedded culturally and also combined with work ethic.
Next, we talked about the importance of focusing on the destination, while recognizing that the path to get there will be challenging and rarely the first one you choose. Blake draws a vivid comparison to climbing a mountain in this clip.
If you're not failing, you're doing something absolutely wrong. And if you're not comfortable in failing, you don't have it. I always preach that there's one destination. Let's say it's to get to the top of the mountain, but there's many paths up the mountain that one can take, and one's not better than the next. You have to be open to the various paths. And inherent in any path, there's going to be obstacles that come in your way. It is part of the game. They're not fun. They're frustrating as all hell sometimes. And you have to be persistent and nimble to get around those. And I'm always constantly preaching about, I don't care what path I have to take to get up the mountain. I'm open to all of them. And let's find the best one. So that gives you the foresight and the ability to kind of scan the environment and not get so pigeonholed on one that this is the one, this has to work. Because if you're so focused and myopically focused on one path, you might be missing the right path that's right beside you. That may give you a shortcut up the mountain or maybe promote an easier journey to get up to the top.
Jason Ilian, co-founder of Highmount Capital and former managing director of Coke Disruptive Technologies, shares 3 keys to leadership.
You can either build a legacy or you can build an empire, but you can't build both. And so we talk about how do we get to invest with legacy builders. And what I mean by that is empires are typically built around a small set of people, a family, whatever it is. But it's about a few people, and it's about a few people controlling a lot. But empires always fall. It doesn't matter where it falls in this generation or next, but even the Roman Empire, as great as it was, imploded because it came from the inside, right? Legacies are different. It's about building something for the long term, and it goes beyond you. And so too many times we think about things as the pie is this big. How big my chunk can I take of the pie versus saying, what if we grow the pie? My slice doesn't have to be as big because the pie itself grows, and that's legacy-minded thinking. And so one of the first views we always look through is, are we helping build a legacy and an empire? Because you don't get to do both. The second piece that we often say is, what are the core principles that have helped build our firm and will help build other firms? And I think there are some fundamental foundational things you can think about. And one is shared vision and values. If you're going to have partners in your investing firm or you're building a company and you need key executives, they have to have the same shared vision and values, which basically means we got to be pointed the same way. If you're even 1 degree off from sailing from New York to London, you're going to end up somewhere in Africa. You can't be 1 degree off. You got to be going the same direction. So that same vision and values has to be the same. But with that comes very different complementary capabilities, meaning if I'm a quarterback, I can't have a team of full of quarterbacks. I need wide receivers and I need running backs and I need alignment. I need complementary capabilities. And I think early in my career, I think it's easy for people to attract themselves to people like them and want to work with people like them versus surround yourself with people that are different than you, share the same vision and values, different capabilities. And then the third piece of that is just align incentives, meaning how do we incentivize all of us to run the same direction at the same speed with different capabilities to be successful. But if we either succeed together or we fail together, what happens as you start building companies and investing in companies and doing things is the incentives become misaligned, meaning I succeed when you fail, or it can happen. I think that's a bad model. And so I think you have to really continuously look at your incentive model, because people do what they're incentivized to do. It's pretty simple, right? You tell a kid you're going to pay him $100 to mow the lawn, you're probably going to mow the lawn. He's going to make $100. If you pay him $5, he may go do something else. And so you got to incentivize people to go and work on the same things together and understand that that pie gets bigger if we all succeed.
Bruno Dell'Ama, a pioneering entrepreneur and co-founder of Global X, one of the largest ETF providers, and Sangha, brings a distinctive perspective on innovation and leadership. First, Bruno reframes leadership as the art of bringing out the best in people. He explains why human dynamics are the most complex challenge and why becoming a great leader is a lifelong journey of personal transformation.
Of course, as you're leading human beings, what you're really doing is you're bringing the best out of them. And that ultimately it's about humanity and what motivates us. And as you go deeper and deeper, some of the fundamental questions of, okay, why is my head of marketing here? And why is my head of sales here? And why is my CFO here? And why am I here? What are we doing? What's the point of this whole thing? And so it was a beautiful journey and exploration that just opened, an entire dimension of my life of essentially going on a journey of, okay, how do I become the fullest expression of being human that I can become? Human beings are the most complex machine, if you want to use that term, that exists. And there's a lot of different things happening that I have now, and it's still emerging, but much better understanding than I did back then. And if you want to be literally the best leader in the world, you almost need to transform yourself really completely. And through that process, have a much better understanding of the forces of what's happening and how is it happening and how does that affect us. And yes, it's certainly a lifelong journey for me. It has been for the last decades, and it probably will be until I die.
Next, Bruno explores the concept of the hedonic treadmill, the endless chase for more, and why stepping off that loop is essential for fulfillment and deeper transformation as a leader.
As the kind of the leadership lesson was when, I told the story how we went from 11 million to 1.3 billion. The business plan that we had laid out for ourselves was to get to 2 billion in assets. And how happy would I be if we ever got there? And we did. And I was thrilled, and it was really exciting. Eventually, not very long after that, I found myself thinking, well, if we got to 3 billion, that would be nice. And we got to 3 billion pretty quickly after that. And I enjoyed that for 5 minutes. And then my mind was reeling again, well, if we got to 5 billion. And I caught myself as I was doing that. And this is a pretty fundamental thing that most humans miss. And the value of catching ourselves doing this is transformational. What is this thing anyway? What was I doing? Why was I doing it? What's the purpose of it? And there's a term that speaks to this called the hedonic treadmill. And 90% of humanity, maybe more, lives in this hedonic treadmill of more and more. And if you think about, you were asking about the complexity of being human, this is a critical point that we need to get to as human beings to really start the process of deep transformation. Otherwise, we just keep ourselves in a loop of essentially guaranteed unhappiness. I may be wrong about this, but I haven't found one single human being that has disproven this.
Well, if you keep moving the finish line, you never get there, right?
I mean, by definition. So if you think about that model, there's two fundamental problems. One, the model of we're setting up our objectives and working really hard to get there with the understanding that when we get there, we'll be happy, which is not true. Like experientially, that is not true. The problem with that to begin with is that, well, a lot of people will not even get to that initial finish line. So there's that. And then those that get to the finish line, then to your point, the finish line, well, then you never get there because in that treadmill, you just keep on pushing it forward and forward. And so I was really struck by the ultimate example. Like if you take all of us 7 billion human beings and you go to what humanity would consider the front of the line, you meet Elon Musk, and he's like literally in front of the 7 billion humans in terms of how we think about success. And there was this podcast that he did with a German journalist, and the journalist asked him about death. And he said, "What do you think about death?" And Elon said, "I think it will come as a relief." And even if that was a throwaway comment, which it could be, it just to me shows a state of mind of somebody in the midst of ultimate success. For him, it's even worse because, if he had one human being with less wealth than him, he could say, well, once I become number one, then I'll be happy. And then he gets there and he's like, wow, I'm not happy. So that catching myself in that process of moving the finish line and realizing the futility and the mental mistake and the implications of that, and the ability through, this is not an easy thing to do, but it's doable, of reprogramming that. But obviously the first step of reprogramming that is just realizing that you're doing it. Because most of us, I was doing it unconsciously, like it was just a thing. And I just was very fortunate to catch myself in that process. And so that to me is probably most fundamental changes that humans need to go through, which is understanding if that's not the game, what is the game?
David Rutherford, a former Navy SEAL, SEAL instructor, and CIA contractor turned motivational speaker and founder of the Frog Logic Institute, shares powerful leadership lessons from his time in the SEALs that translate directly to business and beyond. In this clip, David outlines 4 core principles of leadership development.
There's 4 ideas behind the leadership development. First and foremost, you've got to be willing to be cold, wet, and sandy with everybody with you. Now, in our training apparatus, that's legit. Our officers go through the same training as us, and in many times they get even a greater beat down than we do. They take more heat because the responsibilities are greater. The other is a grander sense of situational awareness, right? I always see what you always hear on big leaders is they try and parse out the critical aspects that they need to focus on. Well, the reality is that if your junior man doesn't feel worthy, that you're interested in what they're doing, then that's going to really, really have an impact negatively on your organization. But the biggest one is those junior managers. The junior managers are the key to the success of every small business, big business, whatever. And if the investment in those people is not dialed in, that's where you start having really significant trouble. So be situationally aware of the different levels of input and influence in your organization. That's huge. And then within those lower levels, if there's no concept that there's a responsibility within them to lead, and that's the way you look at the representation of your organization, you are a leader. You lead in the community, you lead around, and then you're training those people to become a leader, even if that means they go out and start their own business and say, hey, thank you so much. That's the ultimate thing because you've influenced them and given them enough of these ideas. And if you do it the right way, you pay them well, you give them the growth trajectory, you show them the path, they will become as loyal as anybody else. And then finally, as you talked before, Alex, the ability to analyze in the appropriate time what the actual battlefield looks like and then to take risks. And that's the number one thing that I see more often than not is leaders unwilling to take risks because, and most of that has to do with the lack of work they've done in developing their team. They just don't trust their team. They don't trust that if I'm going to take this huge risk, expand into another city or state or whatever, if I don't believe in my team, then I'm not going to take that risk. That's, I think, the biggest challenge is taking smart, dialed in risks as a result of the strength of your team beneath you.
Finally, Alex Ehrlich, founder and CEO of Per Capita, has more than 40 years of experience in global finance, having helped launch Goldman Sachs' securities lending and prime brokerage business and led prime brokerage at UBS and Morgan Stanley. In this clip, Alex outlines his leadership pyramid and emphasizes the importance of building a team-centered culture.
The leadership pyramid is just based on the fact that, one of the few things I learned in college in my year and a half of, getting educated was I encountered Maslow's hierarchy of needs. And that was actually something I always thought was really impressive on just a personal psychological basis. after I had left Goldman and I was at UBS and I was trying to build a business, and I knew my job was to sort of figure out how to beat Goldman, which was a great firm, had these observations about, what we already talked about, your brain and your work ethic and your integrity. That's just kind of like the bottom of a pyramid, like a ticket for admission to play the game. And I started thinking about Maslow and how Maslow had like his pyramid, and every level on the pyramid is sort of a higher level of complexity of meeting human needs. And I started to think, I wonder if there's a behavioral pyramid that describes career success, career progress, behavioral traits, leadership traits, similar to the way that Maslow did his pyramid. And so I used to refer to this as the behavioral pyramid for success. And Maslow had, I think, 5 levels, but I had 4. So it's just a pyramid, and there's 4 levels. The bottom one we've already talked about. The base of the pyramid is you got to be smart, you got to work hard, you got to have ethics. If you don't, you're going to fall off the pyramid, you're out. And now you get into the interesting stuff, sort of the 7 boxes above. And in sort of stratifying those boxes, those levels, what I was trying to do was think of career ascent. So if the bottom of the pyramid is entry level, so let's call it on Wall Street language, that would be an analyst. So that gets you an analyst job. What gets you promoted to associate? Why do we keep you? Because we don't keep you just because you're good at spreadsheets and PowerPoints and, organizing roadshows, because that's not a sign of leadership. That's a low level degree of ability. So you start looking for those behavioral traits. And so on that second level, what I would put would be empathy, because as already mentioned, it's really the cornerstone of leadership capability, is that you are empathetic in your core. It's who you are. Because if you're not, you're never going to be a good leader. And by the way, I could talk about all of these things for, sort of 10, 15 minutes, every box for 10 to 15. The second box on that level for me is self-awareness. And by self-awareness, what I mean is just recognizing that by our biology, we are always the star of our own show. We're center stage in everything we do. Everybody else has a part in our life, but we're the star. And self-awareness in the context of business means that the world does not revolve around you. You are revolving around other people's worlds, including, many, many people above you, many people around you, many people below you. So self-awareness is you can astral project and see where you are on the chessboard consistently instead of thinking the whole thing revolves around you. Diversity. And I do not mean what you look like. I don't mean the type of diversity that is controversial right now. I'm talking about diversity of thinking. I'm talking about, your ability to be comfortable with people who don't think like you, who aren't like you, who don't sound like you, who have different experiences with you. Because that is ultimately a leadership trait, because you're comfortable with people, you will form interesting intellectual relationships and bonds, and you will also be a better manager and leader for people who are different from you. And then the final 4th thing on that level is just showing signs of creativity, that you're not limited to being great at executing what people tell you to do, but you somehow begin to go beyond that and you show signs of bringing value that nobody told you to bring to the table. It doesn't have to be art. It's not artistic creativity. In a business context, you might think of it more as a burning desire for continuous improvement, which drives you to be looking for things that could be better. So that's that like sort of associate level. And then you go up a level. I've only got 3 things left. It's sort of 2 things on this next level and then 1 at the peak. You go up a level and now you're into like an officer level. So let's say again, in Wall Street context, you've gone from analyst to associate. And now maybe you're a vice president, and you're probably at that point, 28 to 30 years old or so. And it's your first officer level job. And there are 2 more traits that I would put on there at that level. One is you act like an owner at all times. You take the accountability that owners take for everything going on around you. You lose that trait that almost every young person has of acting like labor instead of management. Labor, we talk about this labor, you show up, you're like, where's my desk? What do I do? What time do you want me to come in? And, tell me my job. And ownership is, think about it. You own a store and it's on the street front and you're selling, whatever it is you want to sell, whether it's, books or records or clothing. And people come in the store and you're the owner and you have some employees and they're doing their thing. You don't get to ask anybody what your job is. Your job is to do everything from as early in the morning to as late at night as you can stand it to make sure the store is successful. And so people have to make that transition. And by the way, they also have to stop acting like putting their personal interest in front of the ownership interests of the partnership that they are being invited to be a part of. Second, and the only other thing on that level, which I find is a huge differentiating trait for people, is the ability to build your own network. Because in a job, your management is trying to make you successful by making sure you have the tools you need to be successful and you know the people you need to know to be successful. But as we said earlier, they're not telling you how the other 29 floors work. They're not introducing you to the people on the other 29 floors. You want to have a great career and have more and more sort of the lottery tickets in your career to be successful, you've got to build a network. And if you're working at a good firm, there are so many people you can meet who are going to add value to your life and your career, and nobody's going to tell you to meet them, and people aren't even going to necessarily introduce you. So this question of kind of how anybody gets to run Goldman Sachs, as I said earlier, or Morgan Stanley or anything else, it's interrelated to this question of how did they build their network when they didn't need to? And I could talk about that for a long time, but that's everything below the apex of the pyramid. The apex is one thing, and it's usually controversial. I would have do this class, and there's always be somebody that wanted to argue about this, including sometimes very senior people who just really blatantly disagreed with me. And I hinted at this earlier, that to me, one of the central traits of leadership and creatively important for very senior leaders is that those people have to be in pursuit of their own happiness. They have to be in pursuit of happiness, because if they're only in pursuit of success, and many people will take this point of view, like I've had this said to me many, many times. It's like, dude, I did not come here to be happy. Okay. I'm not being paid to be happy. I'm not here to be happy. I'm not here to make you happy. I am here to be successful. And in the context of like the investment banking world that I come from, it's basically, I get paid for three things. I get paid to make money, serve my clients well, and beat Goldman Sachs. And I use Goldman Sachs as an example, not that they're always number one. If you're at Goldman, you're being paid to beat Morgan Stanley. The point is that if that's how you see the world, that's particularly in this era with sort of cultural changes as generations pass on and people are concerned about happiness, you're out of step with the way the world is changing. And you are not going to inspire people to want to be like you. You might be really, really good at your job. You might inspire people to know what you know. People may very well want to learn from you. They may want to be on a team with you so they can, sort of soak up your brilliance. But they're not patterning themselves on you because they actually want to be happy. Secondly, if you're not concerned on your own happiness, people don't think you're concerned about their happiness. And people want to know that the management above them cares, at the very least, about their progress and their career happiness, if not their personal happiness.
These 9 voices remind us that leadership isn't about titles or technical skills. It's about vision, empathy, adaptability, and the courage to take risks while empowering others. Whether it's building a legacy, fostering culture, or staying calm under pressure, the best leaders combine clarity of purpose with a relentless commitment to growth. Number 3, the AI bubble. The AI boom is one of the most talked about themes in markets today. But how does it compare to past technology cycles, and what might the future hold? No one knows for certain, which is why maintaining a balanced perspective on the full range of possible outcomes is essential. While optimism seems to dominate the headlines, here we focus on the potential downside risks. In this early December episode, Rajiv Jain, CIO and founder of GQG Partners and a former AI bull, shares his views on why today's environment may be more vulnerable than the dot-com era, the challenges of scaling AI, and why the biggest winners could emerge in unexpected places. In this first clip, Rajiv explains why today's AI surge may be more vulnerable than the dot-com era.
First of all, it's way more vulnerable. And the reason is the numbers are much larger. The dependence of the economy on this area is actually startlingly high. Let's start with market cap, et cetera, right? I mean, NVIDIA is almost 15% of GDP. So is approximately, give and take, Microsoft and Apple and so on and so forth. But their impact economy is actually far smaller historically in terms of number of jobs that they created and so on and so forth. But the market cap impact is quite significant. Technology itself as a sector is worth almost same as GDP, i.e. $30 trillion. The other aspect is the amount of dollars that are now going into data center, et cetera, as a percent of GDP and as a percent of overall CapEx spend in the whole economy is disproportionate. The problem is this is a very rapidly expiring technology. I'll give you an interesting data point. If you look at the GPUs H200, which were launched last summer, okay? If you go to the distributed network, which we have, that they're now selling between 40 to 50% discount to what they sold 12 months ago. In fact, some of them are even suggesting even the black belt might be available for a discount. We haven't gone the numbers yet, but they are suggesting that you should be able to get that. And these are authorized distributors, by the way, of NVIDIA. The question is, something that can depreciate that rapidly, why there's such a surge in investments when we do know that the Chinese open source models can be very effective? In fact, no other country is doing that. And there might be a good reason why other countries are not investing at this point, because technology changes are so rapid. So unlike the dot-com era, those optical fiber, etc., lasted decades. We're still using them. These may be a lot of stranded assets. Number three, the amounts that are going in are happening on the private side and hence are more opaque. But some of the valuations are completely in Alice in Wonderland. For example, if you look at OpenAI at $500 billion, it's got a finger in the air, whatever they're valued at, for a company that last quarter, third quarter, apparently, based on Microsoft's numbers, had an $11.5 billion loss on approximately $4 billion revenue, okay? And now they're saying they're going to spend $1.5 trillion. I mean, the math, what's fantastic, and nobody's questioning the math. And this one company, if you look at X.AI being valued at $200 billion for under $1 billion revenue. Pets.com was $2 billion. People know Pets.com. Oh, by the way, what's interesting is Pets.com was more than half owned by Amazon. And then it didn't work. But it's $2.5 billion. Inflation adjusted is not $200 billion. So the numbers are completely astonishing. The other part is the circularity. I mean, the whole vendor financing issue, which was heavily criticized in 2001. There are a lot of articles, if you go through Wall Street Journal, etc. Now that thing is on steroids. I mean, today there was another deal announced of Microsoft, NVIDIA investing in Anthropic. And Anthropic then is going to go around buy compute from Microsoft. So they're going to borrow more money and buy back compute from these guys. Almost 40% plus of startup capital is coming from tech companies. So the circularity of these maybe a dozen companies which show, they come as kind of usual suspects in everything. And the size and scale of this is actually massive. Because one thing which is very different, the other thing, by the way, is also different from what happened in .com. The underlying economic growth was actually stronger. People forget, US had a fiscal surplus. In 2000, there was a New York Fed paper discussing what will happen if US government has no debt. Think about it. There's actually Fed research study. We had no deficit. In other words, there was a lot of fiscal flexibility in case there was a recession. And by the way, 2000, 2001 was one of the shallowest recessions. So when you add all these things up, S&P growing a lot faster at almost 17 to 18% compounded annual growth rate going into the peak. EPS growth, now you're looking at high single digits, by the way, right? And that's along with fiscal surplus, because that has obviously massive stimulative effect. So the question you have to ask is, if there's a sort of recession, is the deficit going to go to 10%? If you assume 300 to 400 basis point increase in deficit, what happens in that case? How would the bond market react? Because in 2003, Fed basically cut the rates to zero. So as you can see, there was a lot of fiscal flexibility. The Fed had a lot of flexibility. The corporates had a lot of flexibility. This time around, it's a lot more tougher environment and the valuations are higher.
He then addresses the big question on many minds. Where will AI revenues come from?
The funny part is when people compare to .com, so we actually went back and read some of the old annual reports from 99, 2000, and there was an interesting nugget from Cisco's annual report of 99. It said in the US, the internet economy, as they called it, in 1998 was $300 billion. This is Cisco's annual report of 99, okay, which came in early 2000. Today, revenue from AI is under $25 billion. And if you look at, let's look at OpenAI. More than half of the user base is from emerging markets. India, Indonesia, Brazil, Philippines, Turkey. Do they really have pricing power? Let's look at that. So if you look at the telecom operators, for example, in India, a company called Bharti, the average revenue per user per month is $3.50. I'm not sure that OpenAI would be able to charge $20 for 5% or 10% of the users in India or Brazil or other places. It just won't happen. Not to mention, there's no stickiness because you can change from one to the other in a pretty quick fashion. And third thing is that they have already lost market share to Anthropic in coding, etc. So this is a very fluid space. One of the biggest problem, by the way, which I think is a real Achilles heel for this industry, is it doesn't scale well. What do we mean by that? So if you look at every incremental user that OpenAI gets, it may be equal or more expensive from a compute perspective than the prior one. There's no real economies of scale. In a software business, if you get a new software client, fixed costs are already embedded. So the incremental margins are very, very high. In this case, incremental margin may be worse. If you get a power user, they may completely blow through your budget for that individual. So then they end up throttling them. So think about it this way. You're actually trying to control your best users.
Finally, Rajiv explains why non-tech sectors may ultimately benefit most from AI, thanks to well-defined rules, large data sets, and high barriers to entry, while many tech winners could falter.
Same thing happened with .com. Telecoms were considered winners of all of this. Turned out they were not. Markets are completely wrong. I mean, a lot of stocks like Disney, etc., were trading at, in fact, it was called TMT bubble, tech, media, telecom bubble. So media stocks went through the roof. Turned out a lot of media companies became casualties. So it's not the first time that companies that are considered winners ultimately turn out to be casualties of new technologies. From insurance, like property and casualty insurance. See, when the ground rules are very, very narrowly defined, this thing actually works reasonably well. If the grounds are not defined, this thing can be a complete disaster. Try Copilot on your own, and you won't be surprised if you see very obvious mistakes. But ground rules are very well defined in property casualty insurance, like car insurance, for example, right? So there it should work very well. So our view is that insurance industry would be one of the biggest beneficiaries, because they have huge databases. So they can price policies far better. And the interesting is that is one of the cheapest industries. It is not cyclical. It's versus own history selling a very attractive valuation. Barriers to entry are high, and probably would be a winner. So there'll be different winners than I think the perception seems to be. And by the way, you can see it, right? For example, if you look at software, I mean, most of these software companies were trading at 50, 60, 70, 100 times earnings 3 years ago. Now, all of a sudden, they considered losers, all of this. If you look at last 30, 40-year history, how many software companies can we count as true long-term winners? Microsoft, Oracle, SAP, and then, right? We run out of names quickly. That's the nature of the animal. The long-term barriers to entry tech tend to be very, very low. Buffett was not wrong when he said, look, doesn't invest in tech. You could see why, because it's very hard to predict who's going to be the winner 5, 10 years out. And by the way, like NVIDIA, for example, everybody is developing their own chip, but they're also this customers. If nothing else, they could reduce the demand from those sides.
Rajiv's insights remind us that today's AI boom, while exciting, carries risks that may be underappreciated. Massive valuations, rapid technology shifts, and unclear revenue models. Adoption could take longer than expected, and the biggest beneficiaries may not be the obvious tech giants, but industries with well-defined rules and deep data advantages. No one knows the future, but having a balanced perspective on the full range of possible outcomes can help investors avoid extremes, whether it's chasing hype or dismissing innovation, and position themselves thoughtfully for what lies ahead. Number 2, AI. Lessons from the past, insights for the future. AI has dominated 2025, but to really get a sense of where it may be going, I wanted to first look back to the early days of the internet. The patterns are familiar: bold ideas, rapid adoption, and plenty of surprises along the way. For this segment, I'm doing something a little different. Instead of focusing on one guest at a time, I'm weaving together the voices of 3 remarkable innovators, each from a different era and vantage point. First, Dr. Leonard Kleinrock. He helped build the very foundations of the internet and brings the wisdom of someone who's seen it all, from the first packet sent to today's digital world. Number 2, Jeff Huber. He was at the heart of Google during some of its most innovative years, helping launch products that changed how we live and work. Number 3, Brock Sutton, who's leading the charge on AI implementation at Capital Group, bringing a fresh, hands-on perspective from the front lines of today's technology. You'll hear me jump back and forth between these 3, sometimes connecting their ideas, so you can hear how different generations and backgrounds shape the way we think about AI's future. By mixing their insights, we'll explore what history may teach us about the opportunities and risks ahead. It all starts with ambition. Dr. Leonard Kleinrock, one of the original architects of the internet, reminded us that anything truly worthwhile is going to be difficult, and that's exactly what makes it meaningful. Back in the early 1960s, as a PhD student at MIT, he set out to tackle a problem that really mattered. That decision, to focus on something big and challenging, may have changed the course of history.
I didn't want to work on a problem that was small, difficult, and of little consequence. And most of my classmates were doing exactly that. There was this wonderful new field called information theory. There were many hard, open problems, small problems that needed to be dealt with. And they were busy working on really hard problems and good ones. But I realized that's not what I wanted to do. They wouldn't have impact. Whereas at MIT Lincoln Lab, which provided this chip to me, at MIT itself, I was surrounded by computers. And I knew that one day, sooner or later, these computers would have to talk to each other. And there was no adequate network which would allow remote computers to interact and talk to each other. And I said, look, here's a problem that nobody's working on. It's an important problem. If I can solve it, it will have impact. And I had an approach to solving it. This is exactly what I was looking for.
Similarly, Jeff Huber, former Google senior vice president who helped build Google Maps, Ads, and Gmail, and now founder of Tritomic Capital, echoed the same principle inside Google's culture.
When I was at Google, my boss at the time was Larry Page. And Larry had a very strong sense of anything you're going to do is hard. So if you're going to do it, you might as well make sure that when you achieve it, it matters. And that's really resonated for me as well. And in fact, many times it's easier to, when you have a big mission, a noble goal, something that's going to have impact, it's easier to get others rallied to the cause and supporting it because they identify and they buy into the mission. When you have the right mission, when you have the right goal, the universe conspires for you to help make it happen.
What's really interesting is the vision for the internet has been there for over a century. Listen to Dr. Kleinrock here.
When was the concept, the vision of what we now have as the internet first articulated? When did someone see this? And I can ask people listening to this to wonder, is there anyone they can think of or any person? Well, I'm going to quote somebody, and I'm going to ask you to think about when and who this could have been. The quote said essentially, it will be possible for a businessman in New York to reach out across the ocean using a device no larger than a watch, instantly, at almost no cost, to his colleague in London or elsewhere, and send easily any picture, drawing, text, speech immediately. Now, first of all, whoever that was, they're talking about what we now call the internet. So who do you think that was? And when do you think it was said? It was Nikola Tesla. And he said that in 1908, more than a century ago. And he was talking about the telegraph network. He didn't talk about video because there was no video, but he had the concept.
But vision alone isn't enough. The internet began with open collaboration, shoot for the moon labs, and unguarded innovation, fueled by government support and funding. But as commercialization arrived, ideals collided with incentives. Dr. Kleinrock saw it firsthand, a research network turning into a global marketplace. Listen to him describe his firsthand experience.
In October of 1957, the Russians who were part of the study jumped the gun, and they launched the first artificial Earth-orbiting satellite, something called Sputnik, in October 1957. And that damn thing circled around the Earth going beep, 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 annoying everybody and pointing out that Russia was now ahead of everybody else, not only in space, but in science and technology. That was October 57. Well, then President Eisenhower of the United States said, uh-oh, we've been caught with our pants down. We are no longer leader in science and technology, and that better not happen again. So 4 months later, in February 1958, he formed a research environment. He formed something called the Advanced Research Projects Agency, ARPA, within the Department of Defense. To do what? To fund research and education in science, technology, basically engineering, mathematics, for the sole purpose of bringing the capability of America back up to primacy. in those fields. So we started funding research across the country, educational institutions, etc., industrial research labs. And it started out by funding science in the area of chemistry, aeronautics, physics, biology, space, etc. In 1962, they formed a special group to study computers, and it was called the Information Processing Techniques Office, computers. And the first head of that was a fellow named Licklider, Dr. Licklider, who was a psychologist. And he had the notion that if you put man and computers together, you get what's called a man-computer symbiosis. You get the best of both, and who knows what wonderful things can happen. So we started funding computer scientists around the United States. And the way he did it was remarkable. Oh, God bless him. He would go to some of the great scientists at various universities and research labs at the time. So he'd go to Marvin Minsky at MIT, who was great in artificial intelligence. Said, Marvin, you're a great scientist. You've done great things. Here's a pile of money. Go shoot for the moon. Really go for something big. Failure's okay, but go for it. We're going to give you this money for a long time. We're not going to tell you how to do it. Do what you want, and we're not going to watch you. It's all on your own.
That culture of openness defined the internet's birth. It was all about research. Then came the turning point, the World Wide Web and the first signs of commercialization.
In the early 90s, what happens? The World Wide Web appears. A simple-to-use graphical user interface. And suddenly, all this combination comes in, and now it began to reach out to the consumer world, to the general world. And now, so suddenly consumers are on it, companies are on it. Around this time, on April 12th of 1994, another critical event occurred. The first broad-based spam message was launched. It reached most of the people on the network. It was launched by two lawyers on April 12th, 1994. And what it was a message going out. In fact, I've got a copy of that message, by that email message. And it said, was reaching out and said, look, there's a green card lottery coming up. We will help you get in the lottery. Come to us, hire us, pay us, and we'll let you get in. Those lawyers were advertising on our research network, on our engineering. That's not allowed. We were aghast. We said, ouch. And this time we said, uh-oh. So we sent email back to those lawyers. We said, you can't do this. How dare you? Shame on you. Cease and desist. We sent so much email back to their server that we took down their server. So an unintended consequence of the first broad-based spam message was the first denial of service attack. But it was too late. The commercial world saw that here was a way to reach the consumer public. They realized this is not a research engineering network. This is a shopping mall. This is a social network. This is an entertainment channel. What wonderful capability to reach out and make this into a commercial success. So in answer to your question, it was around that time that the focus and the energy going into the development of the now called the internet shifted from research and engineering to commercialization. The network took a significant shift to the left. And now the energy was how to seduce the consumer to spend their money. And we've seen that development continuously now. And of course, that drove the directions and the energy in the wrong direction. At the same time, since we enabled so many people to come on, we brought in the power of the internet. What is the power of the internet? The power is that anybody with a computer and aligned to the internet, no matter how poor or dirty or banana peels on the floor in a dirty environment, can reach out at almost no cost instantly to millions of people and influence them, connect with them, etc. Now that's the power of the network, and it's also a perfect formula for the dark side of the network. And so it began to emerge. We began to see these terrible things come onto the internet, fraud, denial of service, fake information, etc. And around that time, as it began to emerge, I said, oh my goodness, the internet is going to its juvenile teenage years. and it'll mature. Didn't happen. It didn't happen. The internet is now, in some sense, in a worse situation because these social networks which began to dominate and became influencing what was going on in the information, the misinformation, the motives, the directions. And it's risen in some very nasty ways.
And here's another lesson shared by Dr. Kleinrock. Predicting infrastructure may be easy. Predicting applications is much harder.
We've been able to predict very effectively the infrastructure of the internet. High-speed networks, basically capability in the walls, smart spaces, wireless networks, devices, and high-speed networks and connectivity which works. What we've not been able to predict well are the applications and the services. We didn't predict email coming. It came on and suddenly within months dominated the traffic of the internet. We didn't see peer-to-peer networks. We didn't see user-generated content like YouTube. We didn't see blockchain coming in. We didn't see search engines. We didn't see shopping malls and the social networks. All of these things that have come about.
That shift may hold a warning for AI. We may be able to predict the architecture and hardware, but what's harder and potentially far more important is foreseeing how people will use it. Brock Sutton, who leads emerging client capabilities at Capital Group, puts AI into historical perspective, seeing it as a general purpose technology, much like the internet was in its early days. Here is Brock.
The assumption is, right, it's a general purpose technology similar to the internet, so it will likely impact everything. But I think the interesting thing to think about is we talked about how it's kind of building on the past of compute. This is building on historical kind of compute. And so I think the interesting thing about that there is technology always has the same impact on industry after industry, function after function. So if you look back, it always takes some task, some job to be done, and it makes it cheaper. It drives that price, maybe not down to zero, but close to zero. And the beneficiaries are those that sit in a complementary area to this technology. So like one way to think about AI is to say, okay, what is this technology going to be great at? And how do I position myself as a complement to this technology so don't necessarily compete? So the example I love to use is the internet, because I think everyone can latch on to this. So you have prior to the internet, you had companies that would create content. So you or I would come up with a newspaper article, maybe write a magazine article, create a screenplay for a movie. There was some value in us coming up with an idea and creating content. But if you think about the real winners were in distribution, right? So it was, hey, could you actually print a newspaper? Could you print a magazine? Could you get that to people's doorsteps, to news steps? Could you actually make a movie? Could you get that movie into theaters? So companies with distribution were the previous winners to the internet. Then comes along the internet, and using this framework that we just talked about, it commoditized distribution. It made it free for you or I to send content. Anyone can listen to this, right? 1,000 times over, and it doesn't cost you anything. And so the beneficiaries then were the complements to this. So what were the complements? The first is people that were amazing at content. So think about like the big companies got bigger, companies like Netflix, companies like the Wall Street Journal, New York Times, right? Those big kind of brand names. And then on the other end of the spectrum, you had this massive long tail of individual creators that could have never existed before, but can because distribution is now free. So that's what was commoditized. The complement was this piece. If we use that same framework then and we think about AI, the question becomes, what will AI commoditize? What will it drive the price down of? And if we've seen anything within the technology so far, it's really driven down the price of things like analysis and starting to, with some of the agentic workflows, things like actually execution. So you or I, right, we can have any kind of question we want, and we can use the tools today to come up with a well-researched 10 to 15 page research report on that given topic. It's making it essentially free for us to analyze anything. And then more and more with these agents where they're able to go out in the world and make decisions, it's actually driving down, again, similar on the execution side. So if you pull that thread, then what starts to matter more is ideas. So where you point this technology, the questions you ask, the agency you have, those types of things, that's what becomes even more valuable in this type of environment. So it's hard to say, hey, what will exactly happen within that space? But I think that's one framework.
I asked Brock, how we should think about our roles in an AI-enabled world. Should we focus on the tasks where humans add unique value rather than trying to compete with computers at what they do best? Here's how he answered.
One of the things to make sure that you do to stay in that space is to stay close to the technology, right? And use it so that you understand, where is this good enough? Where is this becoming more expert in than I am? One way to think about it too is like this kind of floor, lower ceiling razor, where it makes us somewhat proficient in almost anything, right? We can be somewhat competent. But in the areas that we're truly expertise, it 100,000 X's, our abilities and others' abilities. So I think that's like a good way where it makes everything somewhat approachable, but in the areas that you truly are an expert, it also, 10, 1,000 X's you.
And this is really what innovation is, right? You've had other breakthrough technologies in the past, electricity, you talked about the internet, and what it does is it creates new opportunities. And at the same time, people have to evolve as technology evolves. And it's probably a mistake to ignore it. You're probably better off trying to be front-footed, try to understand it, figure out how it can help you. And I guess a simple way to think about it is humans plus computers is probably better than one or the other alone.
Yeah, I completely agree. And I think one of the other things that's kind of fun to think about is think about if we had listeners 100 years ago that were listening to this podcast, and we would have to describe to them, this is a job. We're doing a part of our job right now. They would probably say, that's not a job. That's not real. That's a fake job. And so I think one of the interesting things to think about is how will we look at jobs in the future, maybe in that same dynamic where it's like, it's very different than what we're doing today. It's very serious to those of us doing that in the future, but it does look very different than kind of where we're at today. And so I think we're super early on this evolution. People are just getting started. It's going to take a long time, but I do think it's good to think about what are the endpoints that we may get to.
Here, Brock discusses some of the biggest risks he sees with AI over time.
My concern, one of them, is a little bit around, do humans outsource thinking and reasoning and making decisions? And I think that's a potential risk. I think we need to make sure that humans are able to think, they're able to reason through different problems, they're able to make decisions on their own. Absolutely use AI as a helpful tool, but I think actually learning how to do that for yourself is incredibly important. And I think you're seeing some of this with the education system right now, where because the younger individuals are going to be the first users and are the first users of this technology, they're wrestling with some of the tensions before everyone else. And you're seeing this in higher education and things like that. How do you give a test? What does a course look like in a post-AI world? So I think that's a really important thing to keep an eye on as a society, is make sure that people are able to reason, think for themselves, and use this technology to help them and extend them, but not necessarily replace that function.
I asked Jeff Huber what advice he'd give to people who might feel intimidated by the steep learning curve of new technology. He shared some practical guidance for thriving in the AI era.
So I share this frequently with my kids, that we now live in an incredible time. And I mentioned it earlier, where it was a little bit harder when I made the jump into life sciences biotech after a career in tech. But we now live in a time where anything is learnable. The only limitation is the curiosity and willpower to do it. So just let curiosity drive you. And yes, now the internet exists. Everything is discoverable. Now we have incredible AI tools that can be your coach along the way to be able to learn and develop new skills. And I think a key one of those is AI itself. I think you're going to see differentiation between people who are on the outside and not engaged, and people who are on the inside and using the tools and really pushing what's possible. And Jensen Huang recently had a quote that really resonated for me. It was asked, is AI going to take away people's jobs? And his take was, no, somebody using AI has the biggest potential to take away your job unless you're there and leaning in and continuing to learn. So my encouragement for everyone, for my children, my son just graduated college last year, and my encouragement to him was, congratulations on graduation. You finished the first chapter. Now you've got the rest of the novel ahead, and you need to be continually learning as you go. Your education is a milestone step along the way. It's now lifetime learning that you're engaging in.
Finally, I asked Dr. Kleinrock whether he envisions AI becoming as seamlessly embedded in daily life as electricity or the internet. Here's what he had to say about what the future of AI might look like.
Yes, I do. and it's part of the internet being invisible. I like to imagine, as I did in that vision I had back in July of 1969, I should be able to walk into a room, and the room should know I've walked into it. And I should be able to interact with the room the way you and I are talking now, namely with speech, with gestures, with facial expressions, with haptics, with the way you and I interact without having a keyboard or technology or one of these damn things, tiny keyboards. And it should know what my privileges, my profiles, my preferences are. So it can provide them to me. If I walked up to a physical device, it should be enabled with those capabilities that I want. And it should anticipate what I want, be able to be an agent for me, make suggestions, and interact the way humans do, using all of the internet capability, but the AI tech capability as well. I want an agent with whom I can interact, which is very much like interacting with you. And maybe it is you with capability enhancing you in your interaction with me. I foresee, I like to say, what we're moving to is a global, intelligent interface surrounding us. It's in the ether. It's in the environment. It's in our tables, our cars, our walls, our fingertips, our bodies, and the environment in which we engage.
If we step back, the story of AI may look a lot like the story of the internet. A breakthrough technology, a massive build out of infrastructure, and a rush to build on top of it. As with any major shift, some groups are thrilled by the opportunities ahead, while others are anxious about the changes AI will bring. The key takeaway from these conversations: don't sit on the sidelines, learn the tools, experiment boldly, but never give up your independent thinking. Number 1, why the coming decade won't look like the last. The next decade may not resemble the last. Secular shifts in interest rates, global power, and economic policy may be reshaping the investment landscape. What should investors expect? And how can they prepare for a world that's changing faster than ever? Jeffrey Gundlach, founder, CEO, and CIO of DoubleLine Capital, explains why he believes the era of falling interest rates is over and why investors should prepare for a very different environment ahead. Here's what he shared in our mid-March conversation.
That's my belief that we bottomed on interest rates and that we're in a longer-term cycle of rising interest rates, which is going to be very interesting because we had a treasury debt that was like 3% on average, and now it's moving towards 4%, and depending upon where rates go, it could go higher. And if you think about that, you get to some very uncomfortable arithmetic regarding interest expense. And this is something that I talked about 2-3 years ago when people were saying rates will never go up, rates will never rise. And I used that famous photograph of then Cassius Clay, Muhammad Ali, with Sonny Liston, I think it was, where he looks like Liston's never getting up. He just looks like he's out cold. And I used that graphic and I just said, we've got to start thinking about where this interest expense problem may go. And of course, now that it's higher than the defense budget, and not even the official defense budget, the true defense budget includes Ukraine and the Israel situation, all that stuff, the interest expense is already higher than that. So over $1 trillion, I think it's running at about $1.3 trillion right now, up from $300 billion just a few years ago. And I think that is very strongly a reason why interest rates are in secular rising position, because the deficit is percentage of GDP keeps going up, and the interest rates that are rolling off, we still have some 25 basis point stuff that's rolling off. There still will be for some years to come. We have a strong possibility that people won't want to lend us money at low interest rates, especially for a long-term period of time, especially if the dollar starts falling. So typically in a recession or a weaker economy, you get lower interest rates and you get a higher dollar. I think it's going to be the opposite, because I think we're living in a mirror image of the 40 years that are informed by falling interest rates. And a lot of people have never experienced high interest rates, rising rates, and no junk bond investor has ever really experienced a rising rate default cycle, because when defaults would show up, the treasury rates would fall and you would have some capability of refinancing. So instead of going bankrupt, you could refinance. That can't happen in rising interest rates. So I think the corporate CFOs have been very smart, and they've definitely managed their debt burdens pretty well. They've pushed the maturities out. It isn't a problem in the next few years. But if ultimately the maturities will come. And will they be able to refinance? Will they have to default? I think defaults will be higher in a rising rate environment than they were in a falling rate environment. Yet the junk bond market has only existed from the early 80s. So it's been nothing but falling rates until recently. And there hasn't been enough economic stress with these rising rates for the past 3 years or so to cause significant increase. Defaults are going up, especially on bank loans, but it hasn't been a deluge that you typically see during a significant recession.
He also discusses the potential for a major inflection point in markets and policy.
I'm quite fond of Neil Howe's work. He's a demographer. He wrote the book called The Fourth Turning in 1996 or 1995 when he used demography to predict the global financial crisis. And he said it would come somewhere around 2006. So it was pretty accurate. But his work is based upon this concept of turnings. We used to talk about the Kondratiev cycle years ago. No one really talks about that anymore. It was basically a 75-year thing. And it turns out there's a logic behind why it's every 75 years or so. And it has to do with the fact that societies get a framework. And it starts out in a context of crisis, typically. But the framework is agreed upon. And it's designed to be in harmony with the production, to put it in the Marxian philosophic terms, the means of production. And the means of production get addressed through how you split up the rewards of the economy. So there's the production of the economy, and then there's the property relations, which is how you divvy it up. And it starts out where they're in sync. But there's a natural tension, which is unavoidable, where the property relations don't want to change. They get set in place, and the people that benefit from them work hard to not let them change. The powerful, the wealthy, they don't want that to change. But the means of production change in revolutionary form many times over a 75-year period. Think of television, think of the internet, think of AI, think of the steam engine, the telegraph, you name it. And so they radically change the means of production, and the property relations get further and further out of sync with the means of production, and it becomes this tremendous tension. And ultimately, it's kind of like having one foot on the dock and one foot on the canoe, and it keeps drifting, and eventually you're going to get wet. You're going to fall in. And so everything has to get ripped up and you have to start over again, and that's where we are. And I think people use different frameworks to talk about this, but they're all cousins of each other. And usually, not always, but usually it leads to some sort of significant conflict like the Civil War, World War II. It happens about every 80 years or so. And Civil War was 1865, it ended. World War II was 1945. Add 80 to that. It's 2025. So you are here on the map, and it's just going to keep coming faster.
Jeffrey goes on to explain why he believes the future could look very different, perhaps even the opposite of what we've experienced in recent years.
I think the endless outperformance of the United States equity market will reverse with this regime shift. If you just look at the foreign investment position in the United States, it has gotten so big. It's $23.5 trillion. 15 years ago or so, it was was the net investment position. So the outperformance of the U.S. has attracted money into the U.S., and that's led to a virtuous circle of U.S. outperformance because the money keeps piling in because it's a one-way trade, particularly versus EM. I mean, it's been going on for like decades. And versus Europe, it went on pretty hard for over a decade, but that's suddenly reversing now, which I think is a tell on this one-way outperformance. It's driven in large extent by flows, and flows reverse or can reverse. And when they do, particularly if we're getting bellicose with other economies and other governments, well, people used to talk about China not reinvesting their treasuries, but quietly they've been doing that for a long time. I mean, they're already down by $600 billion from their peak. That's already happened, but what if that accelerates? And what if the non-cooperation, which obviously is the tariff rhetoric in just the past month, has gotten people not getting along. I mean, we've got the Canadians booing the NHL, the Star Spangled Banner when they play it in Toronto or Montreal. So That's all part of things disassociating. My strongest belief on how this regime will play out is the mirror image concept. I think the dollar will go down as the economy weakens. I believe that's happening. I mean, the dollar is already down by 10% from its highs, and it's fallen quite a bit just in recent months. And most people say, I know this. I've been doing this 40 years. I know exactly how this works. When the economy goes down, the dollar goes up. I think it's going to be the opposite. And I think during recessions, the U.S. outperforms, emerging markets don't do well. It's going to be the opposite. And so I really strongly suggest that investors that are U.S. dollar based, and I'm sure this is true, the predominance of U.S. citizens, they have almost all of their investments in the dollar, almost all. And I think it's been such a comfortable thing to do because it worked in a nonstop way. But that's starting to change too. The investment consequences of this is you want to be much more diversified. People talk about 60-40. I think 60-40 went out the window with zero interest rates. And then we had the bear markets and stocks and bonds when the interest rates were rising. I've been advocating more diversification, not just 60-40 stocks, bonds, but just take a look at what's happening with gold. Gold, actually, if you take a very highly convenient start date, which is the year January 1st, 2000, so it's been 25 years, stocks have done quite well. Gold's done better. And if you just look at the S&P divided by gold, it hasn't rallied at all. So we're starting to see interest away from traditional dollar-only 60-40 types of investments. That's why I believe gold has been so strong when other commodities have been weak. It's not so much for economic purposes. It's people are, by degrees, monotonically gaining mistrust in the way all of this is being run.
I asked Jeffrey to rank U.S. stocks, non-U.S. stocks, bonds, and gold for the next 10 years. His answer offers a telling glimpse into how he sees the coming decade.
I think number one would probably be non-U.S. stocks. Number two would be gold. Number three, I guess it would be U.S. stocks.
It's a close call between that and bonds.
Yeah. If you'd asked me that 18 months ago, I would have been much higher up on bonds. I mean, the yields were much higher.
I posed the same question to Julian Brigden, head of Macro Intelligence 2 Partners, in mid-April. Here's his quick take.
I would do precious metals, non-US core stocks, tips, US stocks, and US bonds.
Julian also warns that the global order may be shifting, drawing on historical context to frame the risks and opportunities ahead.
We've obviously been in a sort of post-war period. We've been post-Second World War period, in a period where it's been Pax Americana. And I think the problem with these systems is not, we've had 7, right, throughout kind of history, and not one has survived the test of time for numerous different sort of reasons. But, typically they tend to boil down to this sort of concept of imperial overreach, that in the imposition of enforcing this system, often, as I said, onerously, if you say the Roman Empire, you'd stretch yourself too far, you don't have enough troops, you can't fund the troops. The Visigoths and the Huns end up attacking you and then turn up on the outskirts of Rome and sack Rome, right? And the whole system sort of collapses. There often it comes with financial strains. It often comes with technological changes which challenge your technological dominance. And so they just haven't survived the test of time. And there's also this military tone that exists with it, this element which exists to it, which, as I said, either is forcefully imposing the rules or benevolently imposing the rules. But it's a very important, that role, particularly, let's say, in the current system, the US has provided a military shield security to its allies. And in return, they've been willing to work in a US-dominated system, which is what the US set up after the Second World War. And all those benefits have derived from that. And in terms of financial flow, it's basically boiled down to the point that foreigners are prepared to fund our spending, our excessive spending, in return for us providing that protection. And in that sense, we've hit this tipping point, I think. I mean, I don't want to get overly complicated, but in economic terms, it's referred to as kind of Triffin's dilemma when you are the reserve currency, that essentially the costs to the reserve provider, in this case, the US, of providing that currency and keeping it stable and keeping it strong begin to outweigh the perceived benefits. I will say perceived benefits because I'm not sure that we're going to be right, that the costs are higher than the potential benefits we can gain. And so this leads to a reassessment within the reserve provider. And that's certainly, I think, what the Trump administration is manifesting in terms of their policy. We are in danger. I think, firstly, we're definitively changing the rules. I think that is going to have very significant consequences. And I think also we are potentially changing the rules and changing our approach to such a degree that it potentially threatens, at an embryonic stage, Pax Americana. Look, I will say this, Alex. For most of any trending market, macro is marginally important, but it isn't the driver. Macro really comes into its importance at inflection points. And I think we are at a possibly a 80-year inflection point, so like a post-Second World War inflection point, but at a bare minimum, a sort of 40-year inflection point, 30, 40-year inflection point. And so I don't think macro has been any more significant than it is now.
I then asked Julian whether even seasoned investors, those who've been in the markets for decades, might be surprised by how much market relationships could change in the coming decade. Here's his response.
I think if you've been investing for 40 years, you've seen these before, right? But, you know, I'm pretty old and I haven't been investing quite for 40 years. And there are days when I certainly wake up and feel like I've been investing for 100 years every single day. But I was certainly around and corpus mentis enough to sort of understand. I mean, I already started in like 87. But in the 40-year thing, I'm talking the last time we saw a currency accord. And I do want to stress, as a retail investor, getting the trend in the dollar right, as certainly as a US investor, will determine all your gains. If you get the dollar wrong, you will be invested in the wrong sectors, you will be invested in the wrong countries, and you will be invested in the wrong assets. Okay? Now, in terms of trends, I would say that certainly to assume that we continue the trends of the last, as I said, I think these trends really started in 2014, but arguably in 2011. So if you think that we continue along the path of the post, let's say, global financial world, where US assets continue to just inexorably outperform, where we continue to suck in ever greater percentage of global savings. I mean, at the moment, the US demands, just to keep the relative performance where it is in the equity space, so US against the rest of the world, demands that it takes 70 cents of every $1 that goes into global equities. 70 cents. So what's that going to grow to? 80? 90? 100? So no one's going to buy any assets abroad. There's going to be nothing worth investing in anywhere else. I mean, those mathematics just doesn't work like that. So I think this relationship depends on an ongoing strong dollar, which the Trump administration doesn't want, ongoing US asset outperformance, which I think is questionable. I think we're breaking some relationships that have been in place over this decade, 15-year period, and a strong, robust economy, which cannot slow down, which cannot go into recession. And I think all of those three are in question, Alex. And I think the consequences in terms of your asset allocation mix are inordinate.
Bob Prince, co-CIO at Bridgewater Associates, one of the world's largest hedge funds, explains why the U.S. is facing a precarious fiscal situation that could pose significant challenges for the economy and markets in the years ahead. Here's his perspective from February.
The relative equilibrium that we've achieved in the United States has been achieved by about a 15-year period of the government stepping in and taking on a lot more debt and allowing a deleveraging in the private sector and a strengthening of household balance sheets in the private sector. And that has left the U.S. government with a big fiscal deficit, but also a big stock of outstanding debt. So U.S. debt to GDP has gone from about 70%, where it was for decades, to about 120%. The fiscal deficit's about 7. It's probably going to be that or higher going forward. What you're left with is that the U.S. economy, you have to roll over the debt. And so you have both the new issuance and the rollovers of the existing debt. The rollovers of the existing debt is occurring at a higher interest rate, which is then increasing the deficit. And that can have compound effects over time. Ray's actually done a good study of this. He's writing a book on the math of that process. It's a precarious situation. It hasn't come home to roost because the U.S. economy has been stronger, the Fed's been tighter, U.S. rates have been higher, U.S. companies, the tech sectors are doing better. And so there's been plenty of capital flow into the bonds. But you're going to be issuing, the U.S. government's going to be issuing 25 to 30% of GDP every year, as far as the eye could see, of bonds. And while you normally roll over the bonds, the holder of the bonds has to choose to do that. And if the holder of the bonds is a foreign government or someone who doesn't necessarily want to hold the bonds anymore, you're susceptible to that. 43% of the outstanding debt is held by either foreign entities or the U.S. central bank. The Fed doesn't want to roll over the bonds anymore. So that's a situation. Debt rollovers is not something people pay a lot of attention to, but if you look across emerging economies, it's always the inability to roll over debt that is the currency crisis and the financial crisis. It's not the new issuance per se. It's the combination of the new issuance that also scares people out of the rollovers. The rollovers of U.S. Treasury debt is going to be a big issue going forward, both because of the rise in the interest rate that's going to get paid and the potential that the people that hold the debt don't want to roll it over. That's also one of those cascading risks. If it happens, it doesn't happen in a small scale. It's like the avalanche tipping point risk.
Bob then contrasts the wide uncertainty and risk of extreme outcomes with how most investors are actually allocated, emphasizing that despite the need for strong diversification, most portfolios remain poorly diversified. He also highlights the importance of global diversification, pointing out that better pricing opportunities and lower expected correlations across countries make it even more critical going forward. Here's his perspective.
If you look at what the typical investor is holding, your point number one was diversify, poor diversification. If you look at investor portfolios today, including institutional portfolios, they have more equity risk than ever, which is a bias to favorable growth and easier money. They have more equity risk than ever. They have more U.S. equity risk than ever, 67% of the total world market cap, which means almost 70% of all the dollars that are going to equities need to go into U.S. equities to keep the price the same. More concentration than ever, the Mag 7, so-called Mag 7. And the top 10 is 30% of the market, which is the most ever. And the valuations is near the highest ever. And particularly for a foreign investor investing unhedged into the U.S., the dollar is also near the highest level ever because of the favorable view of the U.S. and favorable actual outperformance of the U.S. economy over the recent decade or so. And you've got all of those converging at highest ever, which then means if you translate that into what's being discounted, a very favorable set of circumstances is being discounted, and there's a really narrow path for that really working out to get a good risk premium on that particular portfolio. There's a reason we are where we are now. It didn't happen randomly. In the last decade and more, the U.S. has been the best performing economy, and U.S. companies have been the best performing companies, and the earnings growth that has actually supported that pricing up to now. So if you take the Mag 7, they've had a 20% annualized earnings, but it's discounted to be 13% a year. And if you look at the rest of the market, the other 493, they've been sort of dragged along because they're now discounting roughly 8% earnings growth in the future to have a normal risk premium. And it's never been that high. Theirs was 5% looking back. It's discounted to be 8%, and it's never been that high. So the U.S. market has been dragged along. The total market has been dragged along by the outperformance And this idea of U.S. exceptionalism reflects that, yes, over the last decade, the U.S. did have exceptional performance, and it was not discounted a decade ago. I don't know if people don't recognize that, but a decade ago, the tech sector was not really priced that much differently than the market, and the U.S. was not priced that much different than the market. And then all of those things vastly outperform, which led to relative to discounted great performance. But now it's discounted to continue into the future or more. You're betting on a lot to have that concentrated position. And I agree with you on the global diversification that I think this is a tremendous opportunity for global diversification. You go back to the 70s and 80s, and global diversification was the thing to do. Then you hit the 80s and 90s, and with globalization and global capital flows and global trade, China comes along, and China's got a currency that's pegged to the dollar. Their monetary policy is connected to the dollar. Asia was just manufacture and export to the West. It was a singular global economy and a singular global market. And the correlations between markets got very high, 80, 90%. And everybody's like, what's the point of global diversification? But now, if you look at this world of modern mercantilism, tariffs, the involvement of governments in business activities, as well as the differences in fiscal policies, the difference in monetary policies, the differences in inflation rates, and the differences in how countries dealt with COVID. And particularly Asia dealt with COVID through social measures, and therefore they've never had an inflation. The US and Europe, UK, the West dealt with it by printing money and fiscal stimulation, which then caused the overheating. And so we've been getting a negative correlation between the East and the West because of that complete difference in macro circumstances. And we're getting the echo of it now, even forward, the secondary effects of that, combined with the need to diversify because of the uncertainty that's created by what governments are doing in the market. So I think that the expected correlation of global markets is now low again. And actually, it's an opportunity and actually a necessity to diversify globally. If you don't diversify globally, you don't want to be sort of randomly hit by one of these circumstances. There's no reason to be concentrated because you can be reasonably globally diversified. The super optimistic conditions that are discounted in the United States are not discounted in other countries. So the discounting is very different.
Joe Davis is the global chief economist and head of the investment strategy group at Vanguard, the world's second largest asset manager, overseeing $11.9 trillion as of October 2025. Drawing on findings from his recent book, which explores how AI and other megatrends will shape investments, Joe explains why the next decade may look very different from the recent past. He describes a coming tug of war between demographics, debt, and technological innovation, and what that could mean for investors. Here's Joe.
Full disclosure, if I fill out these surveys, what will growth be over the next several years or inflation? I mean, just imagine my role. I'll call them consensus surveys. And for the United States, for an example, I say, 2% growth, 2% inflation, the Fed's goal, generally speaking, or forecast. Other IMF, other central banks, it made a lot of sense to me. And that's what our central tendency would be. What I was surprised to find is that when you look beyond certainly a year and you start looking out 3 years, 4 years, 5 years, as these factors are evolving, both on the positive side, the potential impact of AI, because we've incorporated technology in its 3 dimensions, its ability to automate, to make us more productive or to augment our work, as well as unleash new industries. And that's where that data set's really valuable, as well as some of the negative forces, right? The aging of society, we've tied our deficits, our fiscal deficits and our debt spending to that sort of aging, given Social Security and Medicare, Medicaid. And so it's that push and pull of those 2 factors, which means dependent upon their relative strength of AI or the lack of productivity and some of the lift that we'll need for higher growth, which is where you get the unlikelihood of this balance of 2% growth and 2% inflation. I was not looking for this diagnosis. If you had asked me 3 years ago, I'm on record saying, 2% growth, 2% inflation makes sense. What I was surprised to find is that that's what is most common in the industry.
it's actually the least likely outcome because of this tug of war that is emerging in our analytics between on the upside for growth through the AI with some of disruption, along with if it doesn't materialize, it's got to develop more AI and its capabilities and its lift on new industries. If it doesn't, you get more of a lower growth, yet still high interest rates because some of the deficit pressures and modest pressures on our currency. And because of those two competing forces, you can now see where you don't get this 2% growth, 2% inflation. Again, it's possible, but it's less than a 20% probability of happening for a forecast that I think, I don't know, 80, 90% of economists, and again, myself used to be in that camp, used to articulate. So it's a pretty bold economic assessment, but we're not trying to be sensational or grab headlines. It's coming out of our data-driven system.
Finally, Akash Doshi, Global Head of Gold Strategy at State Street, discusses why gold's role as a safe haven may become even more important in a world of rising global debt and a higher likelihood of monetary intervention.
There's this concern about global debasement. And I think that's been an accelerated phenomenon post-pandemic. And what do I mean by global debasement? I often ask from a bar trivia standpoint, how much global debt is outstanding worldwide? This is government as well as financial, private sector, corporate credit. And this is not just the US, I'm talking Eurozone, China, et cetera. And that number is 350 trillion. I often get answers of 100 trillion or 150 trillion. No, it's over 300 trillion, close to 350 trillion as of 2025, middle of the year. And that's important because you could say, Akash, global debt is always rising, just like population growth. What's the big deal over the last 25 years? The government share of that debt has also risen to record levels in 2025. And there were two market periods in the last 25 years that it really rose. One was during the GFC. The second is during the COVID shock. So not only is global debt at record levels, but the government share of that global debt is at a record level currently. And I think that is something that's really driving these debasement fears and this demand for alternatives such as gold.
Well, that wraps up our top 10 insights of 2025 and brings this year's podcast season to a close. Our next weekly episode will be released on January 7th. I encourage you to catch up on any of the previous 50 episodes from 2025 that you may have missed. I look forward to what 2026 has in store. Thank you for listening. Thanks for listening. We hope you enjoyed this episode. Please visit our website at insightfulinvestor.org to access past shows and learn more about our podcast. If you have questions, feel free to email us at info@insightfulinvestor.org. And if you enjoyed the discussion, please subscribe to this podcast to ensure you don't miss future episodes. And don't forget to forward today's conversation to others you think would enjoy listening. Important information. This podcast is provided for informational purposes only and should not be considered legal, tax, investment, or business advice. It is not a solicitation, recommendation, or endorsement. All opinions expressed by participants are their own and do not necessarily reflect the views of the Evoke Advisors Division of MAI Capital Management, LLC, or Evoke, its affiliates, or any companies mentioned. Information shared has not been independently verified by MAI or its affiliates. MAI Capital Management, LLC, or MAI, is registered with the U.S. Securities and Exchange Commission, SEC, which does not imply any particular level of skill or training. Certain information contained herein has been obtained from third-party sources, and such information has not been independently verified. No representation, warranty, or undertaking, express or implied, is given to the accuracy or completeness of such information by any person. While such resources are believed to be reliable, Evoke does not assume any responsibility for the accuracy or completeness of such information. Evoke does not undertake any obligation to update the information contained herein as of any future date. The content is intended for a general audience and does not constitute a recommendation to buy or sell securities or adopt any investment strategy. Any examples or scenarios discussed are illustrative only, involve risks and uncertainties, and do not guarantee future results. Non-traditional assets carry significant risks and may not be suitable for all investors. Decisions should be based on individual objectives, risk tolerance, and circumstances. Statements herein are general and may not reflect an individual's or entity's specific circumstances or applicable laws, which vary by jurisdiction. Further, speakers' views are personal and may differ from Evoke and MAI recommendations and are not specific investment advice, and do not consider client objectives, risk tolerance, and diversification. Guests may have current or past relationships with Evoke and MAI, its affiliates, or the host, including as clients, service providers, or business partners. Participation does not constitute an endorsement or testimonial. No compensation has been paid or received for guest participation unless disclosed. MAI and its affiliates may have business relationships with entities mentioned in this podcast, which could create potential conflicts of interest. These relationships may include advisory services, investment management, or other arrangements. MAI seeks to manage such conflicts consistent with its fiduciary obligations and policies.